Good morning. This is Arlan Suderman, Chief Commodities Economist at StoneX. It's a little before 9 a.m. coming to you from the trading floor with news over the weekend developing that's certainly impacting the markets this morning. So let's take a quick look at where we are this morning. We've seen soybeans that traded a little over 2% higher earlier in the session, now pulling back a little bit, about 1.5% higher. Corn a little less than 1% higher this morning. Wheat has generally been mixed. As we look at the equity markets, of course, they've been very strong on the agreement that was signed between the United States and China over the weekend. And crude oil prices were roughly 4% higher earlier, pulled back a little over 3% higher now. So what's all the excitement? Well, it's a brand new, beautiful deal, so to speak, between the United States and China, but I'd like to put a little bit of perspective on it. It was impressive what we saw over the weekend. And I think part of it is because both sides have replaced their previous negotiators from Trump 1.0 with people who are a little bit better at relationship aspect. The Chinese culture respects relationship in negotiation, relationship or respect. And so you take these negotiations, took place at Lake Geneva, at the ambassador's home there in Lake Geneva, out on the patio in the shade of a tree overlooking Lake Geneva. And the participants said it created a very relaxed atmosphere where both sides could develop some relationship between them over the weekend and work through some things. And far more progress was achieved than what was anticipated. So basically, what was the agreement? China and the United States struck a deal to slash tariffs for 90 days. That gives them time to work on a more comprehensive trade deal. And it can be extended if there is good progress happening in good faith negotiations. The United States will reduce its reciprocal tariffs to 30%, down from 145% currently. Now, in return, China will slash its tariffs to 10% from the current 125%. Now, the deal did not reportedly include sector-specific tariffs, so some of those will continue, and as such, we'll continue to negotiate a rebalancing in such areas as medicine, semiconductors, and steel, where President Trump believes that we have supply chain vulnerabilities. The U.S. continues to press China on the fentanyl issue, but talks in that area are continuing, although on a separate track. Now, the progress, as I said, was impressive that we reached, but it doesn't necessarily fix the problem that we overall have. We did see stronger stock prices this morning. We saw stronger energy prices, and the belief is that we're going to spur economic growth. Maybe we averted a recession domestically and globally. And we'll probably will see a surge in demand as retailers now take advantage of this 90-day window, which would expire in August, to stock up perhaps even on Christmas supplies so they can have the supplies necessary to meet demand over the rest of this year to whatever extent they're able to do so. That should spur some economic activity, and that means more energy consumption as well. So it's a positive outlook in those markets. What about the ags? Well, when we look at the ags, it's not just about the tariffs overall. And I've previously talked to you about the economics, and it's economics that are twofold. One, currency exchange rates are a big factor. And two, what those currency exchange rates are doing to increase production in South America, converting brushland, not counting the rainforest, brushland into cropland to produce more corn and soybeans. And so if you look, and I looked this morning at soybeans landed at the port in China were 70 cents per bushel cheaper than those that would have come from the U.S. Gulf. 70 cents cheaper, and that's before any retaliatory tariffs were applied. That's just the economics of freight and currency exchange rates and the cost of buying them. Part of that is because of currency exchange rates, and part of that is because over the last 15 years, the lower currency exchange rate in Brazil has encouraged, stimulated, if you will, massive expansion of area planted to corn and soybeans. If you just take the brushland that can be converted to cropland, you could probably get 100 million acres of good land without even touching rainforest and convert it to cropland. And so it's been encouraging that to happen. And when they have the supplies available in abundance, they're cash basis is going to be cheaper. The conversion rates are going to be cheaper, converting the yuan to the RIA versus the yuan to the dollar, and it's going to encourage buying from Brazil. And so China has tended to buy from us when they no longer, or they run out of supplies in Brazil, and to some extent Argentina, which is in a similar situation. Same thing with corn and soybeans being a factor there, and they can even now buy grain sorghum as well from South America. They have the agreements to do so. So those are factors encouraging that. This doesn't change that. What might change it is if we have a trade deal like the Phase 1 trade deal that required them to buy certain quantities regardless of price. Now, may that happen? It may. Will it happen? I don't know. That's yet to be seen. But for now, we don't have that. I think the bigger positive for the soybean market to hold on to is whether we hear from the EPA over the next week to 10 days, like they've indicated, based on comments that have come from Secretary Zeldin, that we should hear an announcement on the biomass diesel production mandate. That expectation has been holding up soy oil and soybean prices. Will that announcement come as expected? Will it be positive? Will it disappoint? That we don't know. We're relatively optimistic based on the comments we've heard from the EPA that we're going to see a strong increase in the mandate, possibly to 4.4 or 4.6 billion gallons, up from 3.35 billion gallons currently. It could even be as high as 5 billion gallons. But overall, we expect that to be positive for demand for cash soy oil and to support the crush industry. And that we have more confidence in than we do in an increase in exports. Now, how does USDA factor all of this into its USDA WASDE crop report supply and demand balance sheets for the coming marketing year, for the 2025-26 marketing year? That's yet to be seen. I'll be doing a webinar later today on that, as USDA will be releasing that report at noon Eastern time today. And so 3 hours later, at 3 p.m. Eastern, 2 p.m. Central, I'll be doing a webinar which you can register for at our website in order to be able to participate in that or get the on-demand version. But in the meantime, watching for the biomass diesel production mandate announcement. We're expecting it before Memorial Day, but based on the comments from the EPA, it could be sooner than that, could be as soon as this week. A lot of times EPA makes announcements on Friday afternoons after the markets close. We're watching that. Another factor to keep in mind here is we had another setback in our relationship with Mexico over the weekend. I do expect it to be worked out, but this is in relation to imports of cattle. If we go back a year ago, basically, Mexico would export on average, it varied quite a bit, on average 30,000 head of feeder cattle, lighter weight cattle, north across the border into the United States that would then go on, depending on their weights, either onto pasture initially, but eventually into feedlots and eventually be available for slaughter for our beef supply. And that was cut off last fall because of a pest called the New World screwworm, which is a bad pest really for livestock that was found in southern Mexico. So it went down to zero imports, and that really tightened up the supply of cattle in the United States. Around the first of the year, we got an agreement for screening those animals coming across the border. But Secretary Rollins of the USDA has been demanding more from Mexico to try to control the worm in Mexico. The last time we had it in the United States, it took 30 years to eradicate it, and she would have liked to avoid it coming back once again. And so she has once again said, not doing enough to eradicate it. So on a month-to-month basis, imports of cattle, feeder cattle, horses, bison have been suspended, and we'll continue to follow. That further tightens up the protein supply here in the United States, or the meat supply, if you will, something we're going to be watching. Later today, as I said, the WASDE crop report, which will impact the ags. Energies find support from this trade deal that's expected to spur economic growth at least over the next 90 days, stock market higher. I'll be out traveling for the next couple of days, but I wanted to get this to you this morning, and I hope you have a good trading day, and look forward to coming back again with you next time.